Welcome back, Econ Junkies, to Boss Economics World, the only show where we break down the financial chaos of the world with the subtlety of a sledgehammer and the sass of a Wall Street trader on a caffeine bender. I'm your host, the Boss Economist, here to shine a spotlight on the economic dumpster fire of the day. And oh boy, do we have a doozy for you today, August 5th, 2025. Buckle up, because we're diving headfirst into the mess that is Donald Trump's latest economic fantasy, lower interest rates in a world that's screaming, nope, not gonna happen. Spoiler alert, this isn't just about Trump versus Fed Chair Jerome Powell. It's about structural forces so big, even the Donald's golden hair can't defy them. Let's get into it. So, here's the deal, folks. President Trump, yes, that Trump, back in the White House for round 2, has been yelling from the rooftops that he wants lower interest rates. Why? Because cheap money is the lifeblood of his economic playbook, tax cuts, military spending, and let's not forget, those sweet stock market gains to keep his base happy. But here's the kicker, Trump's dream of dirt cheap borrowing is running headfirst into a brick wall of economic reality. And no, it's not just Jerome Powell standing in his way, twirling his mustache like a cartoon villain. It's bigger than that. It's structural, baby. Now, for you finance nerds out there, you know what I'm talking about. But for the rest of you, our beloved everyday folks who just want to know why your mortgage feels like a punch to the gut, let me break it down, Boss Economics style. We're talking about the natural rate of interest, the magical, invisible number that balances the supply of savings and the demand for investment, all while keeping inflation and unemployment in check. For decades, this rate was falling faster than a tech stock in a bear market. But now? Oh, honey, it's on the rise, and it's dragging borrowing costs up with it. Let's start with the supply side of the equation, savings. Back in the good old days, think Reagan to Obama, the world was awash in savings. Why? 3 big reasons. The baby boomers, those folks born right after World War II, were in their prime working years, stashing away cash for retirement like squirrels before winter. But guess what? It's 2025, and the boomers are retiring en masse. According to the U.S. Census Bureau, by 2030, all boomers will be over 65, and they're not saving anymore, they're spending. In fact, a 2024 report from the Federal Reserve estimated that U.S. household savings rates have dropped to a measly 3.4%, down from a peak of 8.8% during the COVID-19 pandemic. Less savings equals less money to lend equals higher interest rates. Simple math, folks. Remember when China was buying U.S. treasuries like they were on clearance at a Black Friday sale? From the early 1990s to 2014, China's foreign exchange reserves ballooned from near zero to almost $4 trillion, much of it parked in U.S. debt. Why? To keep their currency cheap and their exports flowing. But now, China's letting its currency float, and their reserves have dropped to $3.3 trillion as of mid-2025, per the People's Bank of China. Translation, they're not funding Uncle Sam's borrowing binge anymore. And don't forget the oil-rich petrostates like Saudi Arabia. Back in the day, they were recycling their oil profits into U.S. treasuries, too. But now, they're spending big on futuristic projects like NEOM, a $1.5 trillion desert city that sounds like something out of a sci-fi movie. According to Bloomberg, Saudi Arabia's sovereign wealth fund has slashed its U.S. Treasury holdings by 20% since 2020, redirecting cash to domestic investments. Less savings flowing into the U.S. equals, you guessed it, higher interest rates. Now, let's flip the coin to the demand side, investment. Everyone and their dog wants to borrow money right now, and it's driving up the cost of credit faster than you can say, AI bubble. Here's why. Governments around the world are racking up debt like it's going out of style. In the U.S., the national debt is approaching 100% of GDP, up from just 30% in 2001, according to the Congressional Budget Office. Why? Tax cuts, military spending, and oh yeah, those pesky interest payments on existing debt, which now cost more than the entire defense budget, $1.1 trillion annually, per the U.S. Treasury's 2025 projections. And it's not just the U.S. Europe's NATO members are boosting military spending to 3.5% of GDP, up from 2%, in response to geopolitical tensions. Bloomberg Economics estimates this will add $2.3 trillion to Europe's debt over the next decade. More borrowing equals higher interest rates. Then there's the private sector, where companies are throwing cash at AI like it's the next gold rush. Goldman Sachs estimates that global AI investment will hit $200 billion annually by 2026, with data centers, power grids, and factory automation leading the charge. But here's the catch, most of this is debt-financed. Corporate debt in the U.S. has ballooned to $13.7 trillion as of Q2 2025, per the Federal Reserve, up 30% from pre-COVID levels. More demand for credit equals higher interest rates. And let's not forget climate change, the ultimate buzzkill. If the US ever gets serious about decarbonization, the price tag is astronomical. Bloomberg NEF estimates it'll cost $10 trillion to transition to clean energy by 2050. That's a lot of borrowing, folks, and it's not even on the radar yet. When it is, you can bet your bottom dollar that interest rates will feel the heat. Now, here's where things get spicy. Trump's not just fighting structural forces, he's fighting the Fed, too. And not in a "let's have a civilized debate" kind of way. No, no, no. He's going full Trump, calling Jerome Powell too angry, too stupid, and too political on Truth Social last week. Classy, right? Trump's big plan. Fire Powell and appoint a low-rates loyalist to the Federal. And with Fed Governor Adriana Kugler's early exit, he's got a golden opportunity to stack the deck. Sure, a Trump-friendly Fed might cut short-term rates in September 2025, especially with the labor market showing signs of weakness. Unemployment ticked up to 4.3% in July 2025, per the Bureau of Labor Statistics. But here's the rub, meddling with Fed independence is like playing with matches in a room full of dynamite. Why? Because the Fed's credibility as an inflation fighter is what keeps long-term borrowing costs in check. If investors think the Fed's just a political puppet, they'll demand higher yields on U.S. Treasuries to compensate for the risk of inflation eroding their savings. And guess what? That's already happening. The 10-year Treasury yield hit 4.5% in July 2025, up from 3.8% a year ago, per Bloomberg data. Bloomberg Economics predicts it could climb to 5% or higher by 2030, thanks to these structural forces. But if Trump's meddling spooks investors, we could be looking at 6% or more. Ouch. So, what does all this mean, folks? For more than 3 decades, falling borrowing costs were the wind beneath the U.S. economy's wings. Washington could borrow like crazy without breaking the bank. Cheap mortgages fueled the housing boom. Low rates supercharged the stock market. But now, that party's over. We're entering a new era where 4.5% might be the new normal for 10-year treasuries, the benchmark rate that sets the price of everything from mortgages to corporate bonds. And if things go sideways, say, if climate change investments kick into high gear, or Trump's Fed meddling backfires, we could be looking at 6% or higher. For context, the average U.S. mortgage rate is already 7% as of August 2025, per Freddie Mac, up from 3% in 2021. That's a gut punch to homebuyers and a drag on the economy. And let's not forget the global ripple effects. Higher U.S. rates mean higher borrowing costs worldwide, especially for emerging markets that rely on dollar-denominated debt. The International Monetary Fund warned in its 2025 World Economic Outlook that a sustained rise in U.S. yields could trigger debt crises in countries like Argentina and Turkey, where external debt exceeds 50% of GDP. Here's the bottom line, folks: Trump can scream, tweet, and fire Powell all he wants, but he can't change the laws of economics. The natural rate of interest is rising, driven by structural forces bigger than any one president or Fed chair. Less savings, more borrowing, and a Fed under siege, it's a perfect storm for higher rates. Now, is this all bad news? Not necessarily. If higher rates are driven by productive investments in AI, clean energy, and infrastructure, that could be a net positive for the economy. But let's not kid ourselves, the transition is gonna hurt. For the U.S. Treasury, for Wall Street, for 401k investors, and for everyday folks like you and me, it's a brave new world of higher borrowing costs. So, what's the boss economics advice? Buckle up, diversify your investments, and maybe, just maybe, start praying that Trump doesn't turn the Fed into his personal piggy bank. Because if he does, we're all in for a wild ride. Until next time, this is the Boss Economist, reminding you to keep your wallets tight and your economic wits sharp. See you in the next financial apocalypse.